Imagine waking up on the first of every month and seeing money deposited into your account. Not from a job, not from a client, but from investments quietly working in the background. No alarms, no deadlines, no boss, just consistent, predictable income hitting your bank account like clockwork. That's the promise that pulls millions of Americans toward dividend investing. But here's the truth most people miss. Dividends don't automatically pay monthly, and building a portfolio that actually generates reliable income every single month takes strategy, patience, and a clear understanding of how the US stock market really works. In this video, we're going to break down how to create a dividend investing system that pays you monthly, not theoretically, but practically, using real principles that experienced investors rely on. Let's start with the basics, because this is where most people get confused. A dividend is simply a portion of a company's profit that gets paid out to shareholders. When you own shares of a company like Coca-Cola or Johnson & Johnson, you are entitled to a piece of their earnings. Now here's the key detail. Most US companies pay dividends quarterly, not monthly. That means if you invest in just one stock, you'll likely receive payments only 4 times a year. This is why beginners often think monthly income from dividends is impossible, but experienced investors know something different. They don't rely on one stock. They build a portfolio of multiple dividend-paying companies with different payout schedules, so income gets distributed across all 12 months. Think of it like building a calendar of cash flow. Some companies pay in January, April, July, and October. Others pay in February, May, August, and November. Then another group pays in March, June, September, and December. By carefully selecting stocks across these cycles, you create a system where money flows in every single month. This is the foundation of monthly dividend investing, and once you understand this concept, everything else becomes a matter of execution. Now, let's talk about what kind of companies actually pay dividends consistently. Not all stocks are created equal. Growth companies like tech startups often reinvest profits instead of paying dividends, which means they're not ideal for income-focused investors. Instead, you want to look at established, stable companies with strong cash flow and a long history of paying dividends. These are often called blue-chip stocks, and they operate in industries like consumer goods, healthcare, utilities, and finance. These companies are not flashy, but they are reliable, and in dividend investing, reliability matters more than hype. There's also something called dividend yield, which is one of the most important metrics you'll come across. It tells you how much income you're earning relative to the price of the stock. For example, if a stock costs $100 and pays $4 per year in dividends, the yield is 4%. Many beginners chase extremely high yields, thinking it will maximize income, but this is where things can go wrong. A very high dividend yield can sometimes signal financial trouble because the stock price may have dropped due to poor performance. Smart investors look for a balance between yield and stability, often focusing on companies with a proven track record of consistent or growing dividends over time. This brings us to one of the most powerful concepts in dividend investing: dividend growth. Instead of just looking at how much a company pays today, experienced investors focus on how that payment increases over time. Companies that consistently raise their dividends year after year are often financially strong and committed to rewarding shareholders. In the US market, there's even a group known as dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. These are not just investments, they are income machines that grow stronger over time. Now imagine combining this with a reinvestment strategy. When you first start investing, your dividend income might seem small. Maybe it's $50 a month or even less. But instead of withdrawing that money, you reinvest it to buy more shares. Those additional shares generate more dividends, which are then reinvested again. Over time, this creates a compounding effect that can turn a modest portfolio into a significant income stream. This is how long-term investors build financial independence, not overnight, but steadily, year after year. Let's also address taxes, because this is something every US investor needs to understand. Dividends are typically taxed by the IRS, but the rate depends on whether they are qualified or non-qualified dividends. Qualified dividends are taxed at a lower capital gains rate, while non-qualified dividends are taxed as ordinary income. This is why many investors choose to hold dividend stocks in tax-advantaged accounts like a 401k or an IRA, where taxes can be deferred or even eliminated depending on the account type. Understanding this can significantly impact your net returns, especially as your dividend income grows. Another powerful tool in building a monthly dividend strategy is exchange-traded funds, also known as ETFs. Instead of picking individual stocks, you can invest in dividend-focused ETFs that already hold a diversified basket of dividend-paying companies. Some ETFs are specifically designed to provide monthly income, which makes them especially attractive for investors who want simplicity. However, it's important to understand what's inside these funds, including fees, yield, and risk exposure, before investing. Now, let's bring everything together into a real-world strategy. Imagine you start with a goal of generating $1,000 per month in dividend income. That's $12,000 per year. If your average dividend yield is around 4%, you would need approximately $300,000 invested to reach that goal. That number might sound large, but this is where consistency and time come into play. By investing regularly, reinvesting dividends, and focusing on high-quality companies, you gradually build toward that target. This is not a get-rich-quick strategy. It's a get-rich-for-sure strategy if executed with discipline. So, if you're serious about creating a monthly income stream from the stock market, the path is clear. Focus on quality dividend-paying companies, diversify across payment schedules, reinvest consistently, and think long-term. This strategy has been used by some of the most disciplined investors investors in the world, not because it's exciting, but because it works. At the end of the day, dividend investing is about turning your money into a machine that pays you again and again, month after month, year after year. It's quiet, it's steady, and it's incredibly powerful when done right. And the best part is, you don't need to be a Wall Street expert to get started. You just need the right strategy, the patience to stick with it, and the discipline to let time do the heavy lifting. As you continue building your portfolio, you'll notice something interesting. Over time, your dependence on active income starts to decrease. Your investments begin to take over, covering expenses, creating flexibility, and giving you options. This is the real power of dividend investing. It's not just about money, it's about control over your time and your life. It's also important to manage risk. Dividend investing is often seen as safer than growth investing, but it's not risk-free. Companies can cut or eliminate dividends during economic downturns, which is why diversification is critical. Spreading your investments across different sectors reduces the impact of any single company underperforming. You also want to pay attention to payout ratios, which indicate how much of a company's earnings are being paid out as dividends. A very high payout ratio can be a warning sign that the dividend may not be sustainable. As you continue building your portfolio, you'll notice something interesting. Over time, your dependence on active income starts to decrease. Your investments begin to take over, covering expenses, creating flexibility, and giving you options. This is the real power of dividend investing. It's not just about money, it's about control over your time and your life. So, if you're serious about creating a monthly income stream from the stock market, the path is clear. Focus on quality dividend-paying companies, diversify across payment schedules, reinvest consistently, and think long-term. This strategy has been used by some of the most disciplined investors in the world, not because it's exciting, but because it works. At the end of the day, dividend investing is about turning your money into a machine that pays you again and again, month after month, year after year. It's quiet, it's steady, and it's incredibly powerful when done right. And the best part is, you don't need to be a Wall Street expert to get started. You just need the right strategy, the patience to stick with it, and the discipline to let time do the heavy lifting.